Tesla is worth more than Toyota. And that shouldn't happen. Toyota sells over 10 million cars every single year, while Tesla sells a fraction of that. By every traditional metric, Toyota should be the more valuable company, bigger production, more consistent profits, and decades of dominance. Toyota built one of the most efficient manufacturing systems in history. It mastered scale in a way almost no company ever has. And yet, the market says Tesla is worth more. That's not just unusual, it's completely backwards. So what does Tesla have that Toyota does not? Why are investors willing to pay more for a company that makes fewer cars, sells fewer units, and has a much shorter track record? Because the answer has nothing to do with cars. And once you see it, the comparison between Tesla and Toyota stops being confusing and starts making a lot more sense. To understand this, you need to look at how these companies actually work. Toyota is not just big, it's one of the most refined industrial machines ever built. Its entire system is designed around efficiency. From the Toyota production system to just-in-time manufacturing, everything is optimized to reduce waste and maximize output. That's how Toyota consistently produces over 10 million cars a year. Now compare that to Tesla. Its factories are newer, its processes are evolving, and its total production is much lower. And yet, despite all of that, investors value Tesla more. That's because the market isn't just looking at what these companies produce today, it's trying to predict what they could become tomorrow. And that shift from present reality to future potential is where everything changes. To put this into perspective, in 2023, Toyota sold over 8.5 million vehicles globally, while Tesla sold around 1.8 million. That's a massive gap, more than 6 times difference in volume. And yet, despite producing far fewer cars, Tesla's market valuation has at times exceeded Toyota's by hundreds of billions of dollars. Even more surprising, Toyota often generates more consistent profits, and in some years, its net income has been significantly higher than Tesla's. So this isn't just a small mismatch. It's a complete disconnect between scale, performance, and valuation. At first glance, Tesla and Toyota look like direct competitors. They both make cars, they sell vehicles globally, and they compete for customers. But the way they operate is fundamentally different. Toyota is built around manufacturing excellence. Its goal is simple: produce as many high-quality cars as possible, as efficiently as possible. That's why it relies on a massive global network of suppliers, dealerships, and logistics systems. Tesla, on the other hand, is built around control. It designs its own software, builds its own batteries, and sells directly to customers without dealerships. Even updates to the car don't require a visit to a mechanic. They can be delivered over the air, like a smartphone update. This is a completely different model. Toyota optimizes for scale, Tesla optimizes for integration. And that changes how each company grows. Toyota grows by selling more cars, Tesla grows by expanding what each car can do. You can see this difference in how updates work. Toyota vehicles typically stay the same after purchase. Maybe you get a new model every few years, but the car itself doesn't change. Tesla cars, on the other hand, are constantly updated. New features, performance improvements, and even interface changes can be pushed through software updates. This makes each Tesla more like a long-term product platform rather than a fixed machine. It's closer to how smartphones evolve than how cars traditionally work. And that shift from static products to evolving platforms is a big part of how investors see value. If you want more breakdowns like this, subscribe. This is a new channel, and we're just getting started. This difference becomes even clearer when you look at how they make money. Toyota follows a classic model. It manufactures cars, sells them through dealerships, and earns a margin on each unit. The only way to grow revenue is to sell more vehicles. Tesla works differently. It still sells cars, but that's only part of the business because Tesla also sells software. Features like full self-driving are not physical products. They are digital upgrades that can be sold after the car is already in the customer's hands. That means one car can generate revenue multiple times, and that changes everything. Software has much higher margins than hardware. Once it's built, it can be sold again and again at almost no additional cost. This is how companies like Apple and Microsoft scale. Tesla is applying a similar model to cars. But even with that advantage, the gap between Tesla and Toyota is massive. So the question remains, is this enough to justify it? Difference in margins is also critical. Traditional automakers like Toyota often operate on relatively thin margins, typically in the range of 8 to 12%. Tesla at its peak has reported automotive gross margins significantly higher than that, sometimes exceeding 17%. That gap may not sound huge, but at scale, it changes everything. Higher margins mean more profit per vehicle, more flexibility, and more room to invest in future growth. And when you combine that with software revenue, which can have margins above 70%, the model starts to look very different from a traditional car business. The real answer lies in what investors believe Tesla will become. They are not valuing it as a car company, they are valuing it as a future platform. Autonomous driving is a huge part of that vision. If Tesla can solve full self-driving, it doesn't just sell cars, it could operate a global network of autonomous vehicles. That's a completely different business. Then there's energy. Tesla sells solar panels, home batteries, and grid-scale storage systems. That puts it in the energy market, not just automotive. And then there's software. Tesla cars are becoming more like computers on wheels, constantly updated and improved over time. When investors look at Tesla, they don't see a car company. They see a combination of technology, energy, and software. Toyota, by comparison, is a highly optimized version of a traditional business. Tesla is an attempt to build something new. And markets tend to reward that potential. We've seen this kind of shift before in other industries. Companies like Apple were once valued primarily as hardware manufacturers. But over time, as services and ecosystems became a larger part of the business, their valuation expanded dramatically. Investors started valuing not just the products, but the recurring revenue and long-term customer relationships. Tesla is attempting something similar in the automotive space. Instead of selling a one-time product, it's building an ecosystem where each customer can generate ongoing value. That's a very different model, and one that markets tend to reward with higher valuations. But this kind of valuation comes with a different kind of risk. Tesla's value depends heavily on expectations. Investors are betting that these future opportunities will become real businesses. What if they do not? What if autonomous driving takes longer than expected or never reaches full scale? What if competition increases in the energy market, or if software revenues don't grow as quickly as predicted? In that case, Tesla's valuation would need to adjust. Because without that future growth, Tesla starts to look much more like a traditional automaker, and traditional automakers are not valued at these levels. That's why Tesla's stock can be so volatile. It's not just reacting to current performance, it's reacting to changing expectations about the future. And that makes the entire story much more uncertain than it first appears. This is why Tesla's valuation can move so dramatically. When expectations rise, the stock can surge quickly, but when expectations fall, the reaction can be just as fast in the opposite direction. We've seen periods where Tesla's stock dropped significantly in a short amount of time, not because the company stopped selling cars, but because investor expectations changed. This makes Tesla fundamentally different from companies like Toyota, where valuation is more closely tied to actual performance rather than future projections. So Tesla isn't worth more than Toyota because it's bigger. It is not. It's worth more because of what people believe it could become. That belief is what drives the valuation. Right now, the market sees Tesla as more than a car company. It sees it as a future platform, one that could expand into software, energy, and autonomy. But that future is not guaranteed. It has to be built step by step over time. Until then, Tesla's valuation will always exist somewhere between reality and expectation. And the longer that gap exists, the more uncertain the outcome becomes. So the real question is not whether Tesla is worth more than Toyota today. It's whether it will justify that valuation in the future. Now you know what's really going on. Subscribe if you want more like this.